Think Ontario's housing market is still climbing? Think again. Behind the maple leaves and suburban dreams, 10 cities are heading straight for a price collapse that could wipe out hundreds of thousands in home equity overnight. Is your city about to take a nosedive? Could that dream home turn into a financial nightmare? Stick around as we count down the 10 Ontario cities where the housing market is cracking wide open. Kingston, Ontario. This limestone city, built around Queen's University, is discovering that when your economy revolves around 18-year-olds, you're in for a bumpy ride. Kingston's housing market seemed bulletproof during the pandemic boom, but in 2025, the cracks are showing everywhere. Let's start with the university crisis. Queen's enrollment has dropped by 8% since 2023, with international student visa restrictions hitting particularly hard. That translates to roughly 2,000 fewer students hunting for housing. When your rental market depends on cramming 4 students into every downtown house, losing that many tenants is devastating. But here's where it gets really messy. Home prices in Kingston jumped 45% between 2021 and 2023, reaching an average of $420,000. Meanwhile, local wages? They've stayed virtually flat. The median household income sits at just $58,000, creating an affordability gap that's getting impossible to ignore. Then there's the infrastructure nightmare. Kingston's aging water and sewer systems are crumbling, forcing the city to impose special assessments averaging $6,000 per property over the next 3 years. Property taxes are already climbing by 4% annually just to cover basic repairs. For homeowners already stretched thin, these surprise bills are the final straw. Investors are bailing fast. Rental properties that once guaranteed steady returns from student tenants are now sitting empty for months. Local realtors report that nearly 20% of current listings are investor-owned, with many slashing prices just to escape. While Kingston grapples with student economics and crumbling pipes, Windsor faces its own perfect storm tied to the uncertain future of automotive manufacturing. Windsor, Ontario. When your city's fate is tied to Detroit's auto industry, you're essentially betting your housing market on decisions made in boardrooms across an international border. And in 2025, those bets are coming up short. Windsor's automotive lifeline is fraying fast. Ford's Windsor engine plant cut 600 jobs in late 2024, while General Motors continues shifting production south to lower-cost facilities. That's not just 600 paychecks disappearing. It's the ripple effect through suppliers, restaurants, and every business that depends on auto workers spending money locally. The cross-border dynamic that once made Windsor attractive is now working against it. Before the pandemic, thousands of Canadians commuted daily to Detroit for higher-paying jobs, then returned to Windsor's cheaper housing market. But remote work policies and tightened border security have slashed that commuter flow by 40%. Suddenly, Windsor's main selling point, proximity to Detroit opportunities, doesn't matter as much. Housing inventory tells the real story. Active listings have surged 65% year over year, with homes now averaging 53 days on the market compared to just 19 days in 2022. Prices that peaked at $360,000 are starting to slide, especially in neighborhoods that catered to cross-border workers. Currency fluctuations add another layer of uncertainty. American buyers who once flocked to Windsor for bargain properties are staying home as the exchange rate makes purchases less attractive. Local realtors report a 70% drop in U.S. buyer inquiries since 2023. Windsor's automotive dependency creates obvious vulnerabilities, but what we're seeing in Northern Ontario shows how even tourism-based economies can face equally dramatic housing corrections. Sudbury, Ontario. When your city's economic heartbeat depends on what's happening in global commodity markets, housing stability becomes a dangerous gamble. Sudbury is learning this lesson the hard way as nickel prices swing wildly and young residents vote with their feet. The mining giant Vale has been Sudbury's economic anchor for generations, but commodity volatility is creating massive uncertainty. Nickel prices dropped 30% in 2024, forcing production cuts and early retirement packages. When your largest employer starts talking about operational efficiency, you know housing demand is about to take a hit. But the real killer is the population exodus. Statistics Canada data shows Sudbury lost nearly 3,000 residents under age 35 between 2022 and 2024. They're heading to Toronto, Ottawa, and even smaller southern cities where career opportunities don't depend on what China decides to pay for raw materials. You can't sustain a housing market when your buyer pool keeps shrinking. Home prices tell a story of false hope, followed by harsh reality. Values jumped 38% during the pandemic as remote workers discovered Sudbury's affordability. But that demand has evaporated faster than snow in April. Properties that sold for $290,000 in 2023 are now struggling to attract offers at $260,000. Infrastructure costs are crushing the city's ability to maintain services. Road repairs, water system upgrades, and snow removal expenses are climbing faster than the shrinking tax base can handle. Property taxes have risen 23% in just 2 years, adding another burden for residents already dealing with economic uncertainty. Sudbury's resource-dependent economy creates obvious vulnerabilities, but cities that experienced rapid pandemic growth are discovering that explosive expansion can create its own set of devastating problems. Barrie, Ontario. What happens when you build a city's entire housing strategy around people commuting to Toronto, then make that commute unaffordable? Barrie is about to find out, and the answer isn't pretty. GO Transit fare increases have turned Barrie's biggest selling point into its greatest weakness. Monthly passes that cost $250 in 2022 now run $430. Add gas, parking, and vehicle maintenance, and the average commuter now spends $850 monthly just getting to work. That's more than many people's grocery bills. The overbuilding crisis is staggering. Developers flooded Barrie with new subdivisions during the pandemic boom, adding 2,800 new listings to a market that historically absorbed maybe 800 homes annually. Drive through neighborhoods like Essa Heights or Salem Woods, and you'll see for sale signs on every block. These aren't resales, they're brand new homes that builders are desperately trying to move. Home prices jumped from $320,000 in 2020 to over $500,000 by 2023. But here's the cruel irony. The first-time buyers these subdivisions were designed for can no longer afford them. A $500,000 mortgage requires household income of roughly $120,000, but Barrie's median income sits at just $73,000. The math simply doesn't work anymore. Young families who move to Barrie for affordable homeownership are now trapped by transportation costs that eat up 20% of their income. Many are selling and moving back closer to Toronto, even if it means renting instead of owning. Barrie's commuter economics are creating a perfect storm, and similar transportation-dependent pressures are building in another city that bet heavily on rapid pandemic expansion: Guelph, Ontario. This charming university town tried to diversify beyond student housing by courting tech startups and young professionals. But when both your key economic pillars start wobbling simultaneously, the housing market feels every tremor. The University of Guelph is tightening its belt hard. Budget cuts announced in late 2024 eliminated 300 staff positions and reduced enrollment targets by 12%. That translates to fewer professors renting homes, fewer students filling apartments, and less spending flowing through the local economy. When your anchor institution starts shrinking, everything else follows. Meanwhile, Guelph's much-celebrated tech sector is heading for the exits. Companies that relocated here during the pandemic for cheaper office space are now moving back to Toronto for better access to venture capital and talent. Local business development reports show 15 tech firms relocated to Toronto in 2024 alone, taking roughly 400 jobs with them. The housing numbers paint a stark picture. Home prices climbed 32% above pre-pandemic levels, hitting an average of $540,000. But local wages haven't budged. The median household income remains stuck at $64,000. That's a gap that's becoming impossible to bridge. The rental market tells an even grimmer story. Purpose-built student housing complexes are struggling with vacancy rates approaching 20% as students seek cheaper options in neighboring cities. Properties that commanded $2,800 monthly for 4-bedroom units are now offering incentives just to fill rooms. Downtown condos purchased by investors hoping to capitalize on tech worker demand are sitting empty for months. What seemed like a smart diversification strategy is proving to be a case study in putting too many eggs in unstable baskets. Guelph's struggles with institutional budget cuts and economic transition are creating ripple effects that extend far beyond this university town into much larger urban centers. London, Ontario. When you're home to both a major university and one of Canada's largest hospital networks, your housing market should be recession-proof, right? London is discovering that even the most stable institutional pillars can crack under pressure. Western University's decision to guarantee residence spots for first- and second-year students has devastated the off-campus rental market. Nearly 4,000 students who previously rented houses and apartments are now living in dorms. That's 4,000 fewer tenants competing for rental properties, leaving landlords scrambling to fill units that once had waiting lists. The healthcare sector, traditionally London's economic backbone, is facing unprecedented cuts. London Health Sciences Centre announced a hiring freeze affecting over 600 positions in 2024. University Hospital has delayed expansion projects worth $200 million. These aren't just jobs disappearing, they're high-paying professional positions that drove housing demand in neighborhoods like Byron and Westmount. Downtown revitalization efforts have stalled completely, leaving core properties in limbo. The ambitious Dundas Place project promised to transform downtown into a vibrant mixed-use district, but funding delays and cost overruns have left half-finished developments scattered throughout the core. Properties purchased by investors banking on downtown renewal are now underwater both financially and literally during London's frequent flooding events. New rental regulations are forcing small investors to exit the market entirely. Rent control expansions and tenant protection laws have made buy-and-hold strategies unviable for many property owners. Local real estate data shows a 43% increase in investor property sales since the regulations took effect. Student housing complexes built during the boom now sit partially empty, with some buildings offering 2 months free rent just to attract tenants. When your primary tenant base shrinks by thousands overnight, the oversupply becomes overwhelming. London's institutional challenges create serious economic headwinds, but what's brewing in our next city represents an even more dramatic collision between speculation and reality. Oshawa, Ontario. Remember when General Motors pulled out of this city in 2019? Everyone said Oshawa would reinvent itself as a modern manufacturing hub. 6 years later, that transformation is looking more like wishful thinking. And the housing market is paying the price. Manufacturing job losses keep accelerating despite bold diversification promises. The automotive parts suppliers that were supposed to fill the GM void have been relocating to Mexico and the southern United States. Magna International cut 400 positions in 2024, while Martinrea laid off another 200 workers. These aren't minimum wage jobs disappearing. They're skilled positions that paid $60,000 to $80,000 annually. The Greater Toronto Area spillover effect that propped up Oshawa's housing market during the pandemic has completely reversed. Toronto buyers who once considered the hour-plus commute worthwhile are now saying no thanks. Remote work policies are tightening, gas costs have soared, and the GO train service remains unreliable. Why buy in Oshawa when you can find similar prices closer to the city? Housing inventory tells the brutal truth. Active listings have reached 3,200 properties, the highest level since the 2017 mortgage stress test crisis. Homes that sold for $450,000 in 2023 are now priced at $395,000 and still sitting for months. Average days on market have stretched to 67, nearly triple the pandemic-era average. Property tax increases are crushing affordability from another angle. Infrastructure maintenance deferred during the GM transition years is now coming due all at once. Water system upgrades, road repairs, and facility closures are forcing tax increases averaging 8% annually. For residents already dealing with job uncertainty, these additional costs are devastating. Oshawa's post-industrial struggles reflect the challenges facing older manufacturing cities, but our next urban center presents a completely different crisis, born from explosive technological growth that expanded too far, too fast. Kitchener-Waterloo, Ontario. Canada's self-proclaimed Silicon Valley North is discovering that tech bubbles don't just burst, they explode. What was once the poster child for innovation-driven economic growth is now a cautionary tale about putting all your eggs in one very volatile basket. The layoff headlines keep getting worse. BlackBerry, the region's former crown jewel, eliminated another 800 positions in 2024 as cybersecurity revenues decline. Shopify's local subsidiary cut 300 jobs, while dozens of smaller startups have simply shuttered operations. Google's Kitchener office, once a symbol of the region's tech prominence, downsized by 40% and relocated key functions to Toronto. Commercial real estate vacancy rates are climbing past 15%, the highest since the early 2000s. The glittering office towers that housed thriving startups now display endless rows of available space signs. When commercial properties lose value, residential markets feel the pressure as property tax assessments shift to homeowners. The condo market tells an even grimmer story. Pre-construction projects worth over $400 million have been canceled or indefinitely delayed since 2023. Buyers who put deposits down on units in developments like DTK Condos and The Sage are fighting to recover their money as developers walk away from projects that no longer make financial sense. University of Waterloo's co-op program, once the region's secret weapon for attracting young talent, is struggling to place students. Placements dropped 23% year over year as local tech companies slashed internship programs. That means fewer students staying in the region after graduation, and less demand for the student housing that drove rental markets. Home prices that seemed justified when software engineers earned six-figure salaries now look absurd. Properties priced at $600,000 are sitting unsold for months as the buyer pool of high-income tech workers evaporates. The tech sector's dramatic contraction in Waterloo region demonstrates how quickly innovation economies can reverse course. But what's happening in our runner-up city shows that even government-backed stability isn't immune to market forces. Ottawa, Ontario. If the nation's capital can't maintain housing stability, what does that say about the rest of the country? Ottawa's government-backed economy was supposed to be recession-proof, but in 2025, Even civil servants are feeling the squeeze as federal belt-tightening meets market reality. The federal government hiring freeze is hitting harder than anyone expected. Treasury Board announced plans to reduce the public service by 12,000 positions through attrition and early retirement packages. That's 12,000 fewer stable, well-paying jobs in a city where 1 in 4 workers draws a government paycheck. When your largest employer stops hiring and starts shrinking, housing demand follows. Public sector pension uncertainty is creating unprecedented buyer hesitation. Government workers who once felt secure about retirement planning are now second-guessing major purchases as pension reform discussions intensify. Why commit to a 30-year mortgage when your retirement benefits might be restructured? This psychological shift is freezing decision-making across the market. The condo oversupply crisis is staggering. 4,200 new units are scheduled to hit the market in 2025, representing the largest single-year increase in Ottawa's history. Developers who started these projects during the pandemic boom are now panicking as pre-sales crater. Some buildings in areas like Little Italy and Hintonburg are offering unprecedented incentives, including free parking, reduced condo fees, and cashback deals. Interprovincial migration patterns are shifting dramatically. Quebec's lower housing costs and improved healthcare services are attracting Ottawa residents across the river to Gatineau. Statistics Canada data shows net migration from Ottawa to Quebec increased 47% in 2024. When your neighbors offer better value, local demand suffers. Government workers earning $70,000 to $90,000 annually can no longer afford homes priced at $550,000, especially with mortgage rates above 6%. The fundamental math of Ottawa's housing market has broken down. Even the stability of Canada's capital can't protect against market forces. But what's unfolding in our top-ranked city shows how quickly prosperity can turn into crisis when multiple economic pillars collapse simultaneously. Hamilton, Ontario. The Steel City has officially claimed the top spot as Ontario's most vulnerable housing market, and it's not even close. Hamilton represents the perfect storm of industrial decline, infrastructure failure, and speculative excess all colliding at once. This isn't just a market correction, it's a complete economic reckoning. The steel industry collapse is devastating. Stelco announced production cuts affecting 3,000 direct jobs, while ArcelorMittal's Hamilton operations reduced capacity by 40%. But the real damage comes from the ripple effect. Suppliers, trucking companies, restaurants, and retail businesses that depend on steel worker spending. Economic impact studies estimate over 15,000 jobs affected directly and indirectly. Toronto spillover. Hamilton's lifeline during the pandemic boom has completely reversed. GO Transit service cuts and fare increases exceeding $400 monthly have made commuting prohibitively expensive. The very people who drove Hamilton's housing surge are now saying the commute isn't worth it. Toronto buyers who once competed aggressively for Hamilton properties have simply disappeared. The affordability gap has become a chasm. Home prices skyrocketed 67% since 2020, reaching an average of $630,000. Meanwhile, median household income crawled up just 8% to $64,000. That's a mathematical impossibility for local buyers. The LRT project has become a municipal nightmare. Originally budgeted at $1 billion, costs have ballooned to over $2 billion, with completion pushed to 2027. Property taxes are rising 12% annually just to service the debt, adding crushing costs for residents already struggling with mortgage payments. Investment properties are flooding the market as short-term rental regulations tighten and tourism declines. Airbnb hosts who bought during the boom are panic selling, often at significant losses. Local realtors report that 31% of current listings are investor-owned, creating unprecedented downward pressure on prices. Hamilton's perfect storm of challenges makes it the poster child for Ontario's housing correction, a city where industrial legacy, speculative excess, and infrastructure failure have converged into an unstoppable downward spiral.